Hello everyone, I'm back, but sorry that I will be away again next week, so the next video will be on 2nd November. Alright, investors were all smiles last Friday as the stock market closed the week on a positive note. This came after President Trump eased worries of further trade escalation with China, while regional bank stocks began to recover from significant losses amid investors' jitters over bad loans and US credit quality. All eyes will now turn to the upcoming week's inflation data and corporate earnings from megacap companies such as Tesla, Netflix and Intel, which will likely decide whether this latest rebound represents a genuine recovery or merely a brief pause before the so-called AI bubble burst. Without further ado, let's dive into the details and do watch till the end for my personal insights. Okay, last week was a mixed week for the US stock market as it struggled on Thursday, weighed down by regional banking stocks. Two US regional banks disclosed problems with loans, allegedly linked to fraud. As a result, Wall Street got concerned about US credit markets and whether that could affect valuations across the market. The sell-off on Thursday even rippled through Asia overnight and weighed on European stocks. Interestingly, these concerns came about after major US banks reported solid earnings earlier in the week. But then, shares of the companies that led Thursday's bank sell-off rebounded one day later on Friday, as investors were betting any bad credit bets were one-offs and not part of a bigger crisis. Also on Friday, Trump said that the talks with China were going well and his meeting with Chinese leader Xi Jinping would go forward. These remarks came after his earlier comments where he said that the 100% tariff he has threatened to add to Chinese goods from 1st November would not be sustainable. This has provided some hopes of a possible de-escalation or perhaps extension of the tariff pause. On the earnings front, Q3 earnings season was off to a great start with the big banks delivering strong results and beating both the top and bottom line. Not just that, the tone and substance of the company's guidance are also mostly reassuring and favorable. American Express was the latest finance player to beat earnings and revenue estimates, and also providing positive commentary about the health of the consumer and broader economy. Earlier on, we had similar results and commentary from companies like JP Morgan, Citigroup and Wells Fargo. Speaking of earnings, it brings me to the next segment, Market Outlook. The latest earnings season is getting into full swing in the next few weeks. Quite a number of companies are due to report in the coming week, featuring results from several major household names, including Netflix and Tesla, which are among the most closely watched companies. We will also get reports from other big names like Intel, P&G and Coca-Cola. On a separate note, the ongoing government shutdown means that key economic reports are delayed, and even when the government reopens, it will take weeks to properly collect and process the missing data. With that said, one important piece of information, the September CPI report has been confirmed for release on Friday 24th October. This will come days before the next FOMC meeting on 28 and 29 October. Industry experts expect the report to show a small and modest rise in overall and core prices. However, even if the impact of Trump's tariffs gets a bit more obvious now, the Fed's biggest concern right now is the weakening job market. This means a small rise in inflation will not stop them from making the widely expected 25 basis points rate cut later this month. Let's now move on to the technical analysis section. When I was away, SPY had a huge sell-off day on 10 October, where we saw SPY decline by 2.7%. That sharp drop brought SPY below that green uptrend line and went near to the 50 moving average. However, the market quickly rebounded, and that's a sign of the continuation of the bullish momentum. For confirmation of this bullish trend, I would say watch that green uptrend line. SPY has been hugging the line for the past 1 week, and if we can get a solid close above it, that's very bullish, and I would say there is then a high probability that we will see a new record high. On the other hand, a rejection by this trend line might see SPY testing the 50 moving average. As long as SPY stays above this moving average, everything is still fine. The bullish momentum is still on. But then, if SPY starts closing below the 50 moving average at around 654 and doesn't reclaim it quickly, then the short-term momentum would have turned bearish because SPY has not traded below this moving average since April this year. Below 50 moving average, the other two key support levels to watch are the 38.2 and 50% Fibonacci levels at 652 and 646. If SPY ever loses the pivotal 50% Fibonacci level in the next 2 weeks, it's pretty bearish in my opinion. When that happens, I suspect something very negative must be happening in the macro environment. Moving over to Apple. Apple's charts looks neutral but leaning a little bullish to me. It's neutral because it has been moving within the all-time high and the first Fibonacci retracement level. It's a little bullish is because that huge sell-off on 10 October has helped to fill the gap. And not just that, after the gap is filled, Apple bounced off the bottom of the gap as well as the first Fibonacci retracement level. That's an encouraging sign, which was why I stepped in to sell a put option. More on that later. Anyway, if Apple continues to go up from here, I think there is a chance that we will climb above 255 or perhaps go near the all-time high at 259. The moment it goes past that 259 hurdle and unlock 260, it's super bullish. In this uncharted territory, I think we can expect a few more all-time highs. On the other hand, if Apple wants to pull back in the week ahead, pay special attention to two key levels. The first one is the 23.6 Fibonacci level at 246. As you can see, Apple has tested this level on 4 trading days and each day it managed to close above it. This means it's a pretty decent support in the short term. But if this support breaks, then watch the second key support level at around 241. This is where the 50 moving average and the blue support line converge, forming a double support level. Again, I would say this support is also a decent and pretty strong one. As long as Apple stays above these two support levels that I have just shared, the bullish momentum is still intact. However, if somehow both strong support levels get broken, then that's when I will say the short-term trend has turned bearish and we could go towards 235 or even lower. Let's move on to Tesla. It's gonna be a huge week for Tesla as the company is reporting its earnings on Wednesday 22nd October. Looking at how volatile Tesla's share price is, I think the earnings results could bring Tesla to either above 460 or towards low 400s. Tesla has been moving kind of sideways and is currently in a consolidation mode, waiting for the next huge move. If investors don't like the earnings, I would expect Tesla to easily break below the 23.6 Fibonacci level at 424 and falls towards the gap area which is between 396 and 402. If Tesla can rebound after the gap fill, then it's actually bullish. But if it doesn't, then pay attention to the 50 moving average at around 387. The bulls have to protect this moving average, otherwise the bears will unlock more floodgates, and before we knew it, we could be back to low 370s. Sorry, a quick shout out, if you appreciate my effort and free content, you might want to consider supporting this channel through any of the following ways. I would be very grateful. Feel free to pause the video to go through the details. Okay, on the other hand, if let's say Tesla manages to impress investors and the Wall Street, the blue resistance line, which has been keeping Tesla at bay, will be broken easily. This means we will see Tesla in the 450s or even 460s range. As Tesla moves upward, watch the recent high of 470 closely. A close above it will almost certainly brings Tesla to the 480s range, which is very near to the record high. And usually near record high, FOMO buyers will likely step in and push the price higher to create a new all-time high. All in all, it is going to be a week for huge price swings for Tesla. So if one wishes to trade the short-term price action, he or she has to exercise extra caution. Let's now jump over to Google, which looks pretty bullish to me. As you can see, the recent pullback has been pretty healthy as it didn't even go below the 23.6 Fibonacci level at around 234. This is a sign of strength, which explains why Google saw a new all-time high last week. In addition, Google has broken out and went above that short-term downtrend channel. Not just that, it did a classic retrace, retest and rebound movement. These are all bullish signs. Another thing to add, the MACD is about to have a bullish crossover. If the crossover happens this week, don't be surprised if Google pushes towards 257 and that's when we will see a few more record highs. I actually tried to sell a put option towards the end of last week, but my order didn't get filled. Anyway, if somehow for whichever reason Google pulls back this week, watch that downtrend channel. If Google bounces off the channel again, then it's still pretty bullish. But of course, if it closes back into the channel, then be mentally prepared that it might continue to fall further towards the first Fibonacci level at around 234. At 234, you might want to stretch it to 231 where the 50 moving average is. The bulls got to protect this moving average. Otherwise, can you see the huge gap? If the 50 moving average breaks, the odds of Google falling into the gap area would rise. This gap area is between 211 and 224. Let's now check out Meta's chart. Meta has been moving sideways for the past 2 weeks, seems to be waiting for a breakthrough. If I were to pick a side, I would say Meta is leaning a little bullish. First of all, it has fallen quite a fair bit from its recent peak of 790, and then it seemed to have found some support at the pivotal 50% Fibonacci level at around 708. At the same time, it has been testing the top end of this downtrend channel, trying its very best to break above it. And here's the interesting thing, the MACD seems like it's on the verge of having a bullish crossover. If it happens this week, it could be the signal for Meta to break out of the downtrend channel and it might start closing above the 38.2 Fibonacci level at around 729. Okay, but I must say a small breakout is nothing, and a breakout can always be followed by a retracement or pullback. So for a full-blown breakout, we would want to see Meta reclaiming the 50 moving average at around 747, or better still, close above the 23.6 Fibonacci level at 755. On the flip side, let's say I'm wrong and the bears start to gain control, then I would expect that 708 support level to not hold anymore. Below 708, do be mentally prepared for the huge 700 level to be broken as well. In fact, if we start closing below 700, I'm actually expecting Meta to test the crucial 61.8 Fibonacci level at 687. This is the last line of defense in my opinion. If it breaks, the bulls would want to look away. Moving over to Microsoft. Well, just when I thought I can offer a bit more analysis for Microsoft, it seems like I can't again. What do I mean? As you can see, at one point, Microsoft appeared to be breaking free from the 50 moving average, but then it couldn't hold above the 23.6 Fibonacci level, and we are back to where we were again, hugging the 50 moving average. To make things simple for you, I will share 3 levels to watch. The first is of course the 50 moving average, which now sits at around 512. So long as Microsoft is trading near this 50 moving average, the trend is neutral. The second level to watch is the 23.6 Fibonacci level, which I have highlighted. This level is at around 524. We need Microsoft to close above it for more than 3 days, or ideally more than a week. Then we can say that the momentum is bullish. The final and third level to watch is the 38.2 Fibonacci level at around 504. Similarly, if Microsoft starts closing below this level for a week or more, then the trend has turned bearish. Anything between these 2 levels, it's called consolidation. Anyway, Microsoft is reporting its earnings on 29 October. It seems like the share price is just waiting for the earnings call before making a huge move. Okay, if you have watched till here, let me throw in the bonus analysis. It appears to me that there is this bullish cup and handle pattern forming on the chart. Okay, I need to caveat that it's not confirmed yet, but if it does play out, the breakout to the upside can be massive. I'm talking about 540's range at least, and I won't be surprised if it charges towards the all-time high at 554. Finally, let's have a look at Nvidia's chart. Nvidia has been moving sideways for 4 consecutive days. Despite looking a little bearish with those few red candles, the positive thing is that it is still trading above the 50 moving average. Come this week, watch that blue resistance line closely for the upside. This line sits at around 184. In fact, we should stretch it to 185, where the 23.6 Fibonacci level is. As you can see, this 184 and 185 area have acted as a strong resistance on many other occasions. So if Nvidia can reclaim this area, we could easily see Nvidia in the 190s range again. And at 190's range, a lot of FOMO's buyers will naturally come in because all the narrative will be positive and they don't want to lose out, which means we could see a new all-time high. If we do get a new record high, pay attention to the huge psychological level of 200. Above 200, I think we will see even more FOMO buyers coming in and the share price could rocket. Alright, on the flip side, if Nvidia decides to pull back, then watch the 50 moving average. This level, which sits at 179, has been holding up pretty well. And if it breaks, I think we could test the 50% Fibonacci level at around 173. Personally, I would say the last line of defense for Nvidia is the 61.8 Fibonacci level at around 168. If that breaks, then it's waterfall time. But honestly, Nvidia is only going to report its earnings in November, so I don't foresee a huge decline towards the 160s range within these 2 weeks. Unless of course Trump comes up with some crazy tariffs for semiconductor chips again. Okay, moving over to the options trading segment, I have 8 trades to update in this video. As always, they are all summarized on the screen. Alright, I will combine the first 3 trades together because they were also on the same day, 10 October, and they are all going to expire on 14 November. So on 10 October, a single social media post from President Trump caused $2 trillion of market value in the stock market to get wiped out. In Trump's Truth social media, he posted that China was becoming very hostile with the rest of the world, especially when it comes to its control of rare earth metals, and he is weighing a 100% tariff on Chinese imports. So yep, that's all it took and the market plunged. And to me, that was an obvious overreaction by the market. For long-term viewers, you should know that I love to step in when the market overreacts, and so I did by selling put options on Apple, Meta and Tesla. And guess what? The market rebounded the following week. Next up is this cash secure put on Nvidia, which was sold on 17 October, Friday. The strike price is 155 and the contract will expire on 21st November. The reason for selling this put option is nothing too fancy. Basically, as mentioned in the technical analysis segment, Nvidia was trading sideways for 4 days, and despite looking a little bearish, it is still trading above the 50 moving average. That's a sign of strength. In addition, I saw that TSMC earnings were pretty decent, which indicates that the demand for AI chips is still very strong, and that should benefit Nvidia. Lastly, given Nvidia is only going to report their earnings in November and that the overall market momentum is still bullish, I think it's quite unlikely for Nvidia to suddenly fall below my strike price of 155 in the next 1 month. Moving on is this cover call on Google. Gotta be honest, I have been stuck with this trade for some time already. The strike price has been ruled from 175 to the latest 200. The new contract will expire on 19 December. Will Google share price plunge to below 200 in December? I'm not very optimistic about it. If it doesn't, I will just roll the contract again in order to save 100 of my Google shares. Don't know what's rolling an option? Do check out my beginner friendly video linked at the top right hand corner. Alright, here are the final 3 trades to update. These 3 contracts expire on 10 and 17 October. As shown on the screen, the strike prices for the Nvidia contracts are 150 and 145, while the strike price for the Tesla contract is 270. From 10 October till now, Nvidia has not gone below 175 and Tesla has been trading comfortably above 400. As a result, all 3 contracts expired worthless and the profit that I caught in total is about $580 after deducting the trading fees. That's about 750 Singapore dollars. Not too bad, I guess. Okay, let's move over to the final segment of the video. I'm going to share my thoughts on the stock market and the so-called AI bubble. First of all, it seems like every single week the US stock market is hit by a new wave of fear. The latest concern came from the banking sector after 2 regional lenders warned that they might suffer losses from alleged fraud cases. And before that, we had the renewed US-China trade tensions. The market's volatility index, VIX, also known as Wall Street's fear gauge, has surged recently and even hit its highest level in nearly 6 months. That tells us the market has become more volatile over the past couple of weeks compared to the quiet low-risk period we had in the previous months. But still, despite all the swings, the S&P 500 hasn't dropped more than 3% in a week for almost half a year, which shows just how resilient the market really is. And if we zoom out, the major indexes are up for the year. The S&P 500, for example, has gained over 13% so far, smaller than last year's rally but still very solid. Overall, the market has done surprisingly well in 2025. Why, in case you wonder? The answer is simple: strong corporate profits and the continued growth powered by AI. Speaking of AI, I know there has been a lot of chatter about a possible AI bubble forming, but honestly, these worries have been around since early this year or even last year. Yet, quarter after quarter, company earnings have consistently showed that the AI boom isn't just hype. It's backed by strong revenue and confidence guidance from the biggest companies in the US. So what if the biggest AI players are throwing money at each other, creating this hotly debated infinite money loop? Critics label it as a bubble, but personally I don't see it that way, at least not for now. The main reason is that there's real revenue being generated, not just speculation. Unlike the dot-com bubble, today's AI infrastructure spending is supported by genuine demand. Companies like Microsoft, Amazon, and Google are already monetizing their AI features, such as Copilot, Vertex AI, Bedrock, and more. These mega-cap tech companies are generating billions of dollars in additional revenue. Meanwhile, Nvidia's record-breaking sales are based on actual shipments and contracts, not imaginary orders. Basically, critics might call it a circular money flow or infinite money glitch, but I prefer calling it an ecosystem. Think about it, Nvidia sells chips to cloud providers like Oracle and Microsoft. These cloud companies host AI apps and software that generate income from other companies and even individual users like you and me. This revenue then recycles back into buying more chips. Therefore, I wouldn't label it as a bubble. That's an ecosystem, or if you wish to give it a more fancy name, a reinvestment loop or AI flywheel effect. My view is that AI is accelerating this ongoing cycle of innovation and productivity, and as long as the reinvestment continues to create real output and measurable efficiency, it's not a bubble. I know from a distance it may look circular, but if you look closer and deeper, it is a self-reinforcing flywheel of innovation, productivity, and monetization, much like how the smartphone, internet, or cloud revolutions play out in the past. And that brings me back to the earnings season. Investors should tune out the noise, whether it is regional banking crisis, trade and geopolitical tensions, inflation worries, or AI bubble fears. Focus on what truly matters, the fundamentals. Pay attention to company earnings, revenue growth, profitability, and guidance. Understand how AI is actually being used, how it drives revenue, cuts costs, and creates a real business value. Okay, but all that said, some stock valuations do look stretched, so it is just a matter of time that corrections or huge sell-offs will come. But the truth is, no one knows when that will happen, and like I always say, there's no point holding an umbrella under bright sunlight waiting for rain. Alright, that's all I have for this video. This week's End Thought segment is a little longer than usual since I was away last week. Hope you found my content useful. Don't forget to tap the like button and drop a comment below before you go. Thanks for watching, and I will see you again in November.